Good day, everybody. Brian here, quantlabsnet.com. Here's another analysis of the three portfolios I've generated today, July 15, 2025. There's three portfolios I've generated using the same data source of a set of ETFs and stocks. Use the AI with a historical uh, back tested and Sharpe ratio as well as part of the filtering. So let me just show you first the um, different portfolios here. These are part of the package you can download if you're a Quant Elite member. Anyways, so the three different portfolios I created was the first one, which was a high potential over the next month that are non-US centric. Okay, that's the first one. And in here, you'll see all the different breakouts, what's suggested, why, and all that fun stuff. Okay. And I'm using both the fundamental and technical analysis as usual. And you'll see uh, what's in those with the allocations of a mock portfolio of $3,000. The other type of portfolio we got here is so this is now a low cost set of opportunities. This one focuses on both stocks and ETFs that are less than $100. Okay. So what this basically does a quantitative analysis among 827 ETFs, and it extracts the holdings that are most profitable and looks at anything with a Sharpe ratio over the last year of 1.5. Okay. So that's basically what we're doing. You can find all of that in the description. Just so you know, this is the highest performing projected portfolio. You'll see why. So it contains Rocket Lab, Robinhood, Kratos Defense Security Solutions, which I've never heard of, and two ETFs, UFO, Procure Space, and ARC FinTech Innovative ARC F. Okay, so that one. And then the other one, which is the normal one I've shown over the last number of weeks, uh, this one, let's say, which is just the normal one I've used. No really any restrictions in terms of price, in terms of okay, let me just give me a second here. Um, and then I'll show you this one in a minute. Okay, and then there's this one as well, which is the normal one of all US high potential. So this one, has a variety of, yeah, it's yeah, it's somewhere in there. I'll just leave it at that. Anyways, let's take a look at the application that was created, which is here. Okay, so I created a Python script, Streamlit, as usual. See which ones would be the projected ones out of those three. Quite shocking, to be honest. Doesn't surprise me, but this is the power of AI. Okay, here we are. So there are the three portfolios. So these are the weighted Sharpe ratio expected monthly return over the next 4 weeks as of today, July 15th. Again, we're putting a $3,000 portfolio. What are our expected dollar return? So in the first one, which is the normal one of expected dollar return, $291, containing a core weave of I think that these are over $100. Okay. So we have here Rocket Lab, Core Weave, Palantir, ARC W, and ITA ETFs. Okay. These are the weighted allocations that are projected, and these are expected returns of each. This is the clear winner right here. Okay. So this is under $100 portfolio, right? So we have now projected 18.55 return, weighted Sharpe ratio of 5.69. Okay. Rocket Lab, Robinhood, Kratos company, UFO and ARF ETFs. This one's the non-US centric. So this one, quite surprising. So this one's got a higher uh, rate of return versus the first one, 14%. Again, the allocated, so we got the Greece MCI ETF set at 30%, which is quite heavy. EWP, which I believe is Spain. This one here, SD, that's a pharmaceutical out of Switzerland. And this one's a kind of very speculative, high performing, high risk Chinese bank at 10%. So that's the historical ratio, sharp, but it specs a 30%, but it's going to lower the risk on the weight allocation. So that's going to bring in 14%. So you'd go, okay, so maybe it makes sense to go with the portfolio of less than $100. So here's the recommended portfolio. Here's the breakdown. Okay. So here's our allocation, pretty balanced. Total amount allocated among $3,000 and the expected return. The KTOS looks like it's in early stages, potentially of bringing in 26% at 195. And, pretty respectable at Rocket Lab, 17, 18%, neighbor and Robinhood as well. ETFs are doing pretty good there as well. So here I've also asked in the AI, I've asked for the expected entry price, stop loss, okay, on the price, take profit two, the stop loss percent, and the take profit upside, okay? So those are pretty good. So on this portfolio, we're expecting 18% over the next 30 days, expected dollar return of 556, weighted Sharpe ratio of 5.69, take profit at 19.6, downside risk at 6.7, which is pretty good considering. I mean, when you listen to President Taco and his tariff talk, that's pretty low, very low for a portfolio of this mix, considering that's pretty low risk. And then the risk reward at 2.92, which is pretty strong for risk reward. All right, so the simulated performance, here we go. So I've checked in. So again, you can see this is forward guidance, okay? This is not stock advice. This is not for, something. This is what this thing says. That's it. So you can see here, the non-centric, it's expected for whatever reason around this time where the portfolio return should drop, okay? So if you were to watch that and use what I had before shown with interactive brokers, where it does go below the stop losses, then you can use that to get out here, if that's the case, to even enhance your portfolio return on this one for the non-US, which could beat, and again, it's all projected, forecasted, on the under 100. But look at the overall return here on the 100, all the way out to the end of, well, mid-August. That's pretty good. So here we have high momentum portfolio up 12%. This is one we're focusing on right here, of 21%, and the non-centric of 6.23. I think this would be the lowest risk one, but even if you can get 6.2%, you're doing pretty good. So here's the simulated trades on the entries. Okay. So it's saying it probably, whatever's going to happen on July 20th, 5 days from now, it's going to do an entry. Okay. And these are the projected returns and equity curve of each one. Okay. Based upon these entries on June 20th. Don't ask me why that date. That's projected. This is where I got interesting. I've never shown this before. I've never even asked for it. The historical back test of each, and I did that as a 6-month historical back test. I've said this before. When you're wasting your time coding up historical back testing and iterating over and over again with back testing, you don't need to do that, because guess what? You can get the AI to do it for you. So here it is. This is the performance since February. Very dull projections on these portfolios up until May. Everything started to take off from there. So when you look at the under $100, look at that return right there. So you've got The highest under 100, returning 9%, I believe, or K, uh, overall. Um, so that's pretty good. Now, this is the important one here. I've asked for to show me the drawdowns over the last 6 months. Okay, so you can see here the deepest drawdowns are on the non-US centric, okay, because they're more high, they have higher volatility with deeper drawdowns of negative 30%. That's pretty worrying. Okay. So what I said earlier that you might be lower risk, no, we're not seeing that here. And that's on historical data over the last 6 months. Here you can see the other one of in purple, I believe. Non. So you can see here under $100, zero didn't have any drawdowns. But when you start getting into here, let's say right here, what's our draw? Let's do about here. So the under 100, 17%, the high momentum at 7%, and then the non-US at negative 27%. We're projected as the market has improved. There's been no drawdowns in these portfolios since then. It looks like I'm not seeing. There's some drawdowns here. Yeah, they're fairly low. -3, -5. I can live with that. So here's the historical performance. Max drawdown at -7%. So I believe I'm not sure if that's combined. Average return 12%. Uh, average monthly return pretty good, 26%. Max drawdown of 31%. And hang on here. Let's see here. Not sure which portfolio each one of these is for. Yeah, it doesn't give me a title here. I could probably ask CA to do that. But anyways, latest simulation. Again, to make sure we understand this, backtest, realistic volatility based on each asset's Sharpe ratio, different market regime, normal period, high volatility correction, recovery phase, and asset correlation to simulate realistic portfolio behavior. And that's moving forward over the next 30 days. Historical performance is simulated based on risk return characteristics of each portfolio is not guaranteed of future results. So I'm sure you're aware of that. But you can see here, based upon what I'm seeing, yeah, the under 100 is the better one. And it's lower cost, right? Because if you look at some of these stocks like Palantir, it's a couple $100, CoreWeave, over $100. So what I find historically, if you go with a lower cost portfolio or set of assets, generally you'll find you'll get better performance because those are in early stages of a boom, I guess you could say. Whereas both CoreWeave, Robinhood have had performance performance bursts in the early days because of the buzz on those stocks. Whereas these other stocks that are mentioned here, like especially this K toss, this defense one, this one right here in green, that one looks like that might potentially go take off because that's a uh, defense stock on top of its for military drones. I've never heard of it. The EA does the work, and there you go. Same with Robinhood may start to perform again, and then again Rocket Labs like that. Elon Musk's SpaceX competitor that's doing okay, and then the other two ETFs on top of that. So this kind of makes sense from my perspective, and hopefully you get something out of it. So if you like this sort of thing, go over to the quantlabsnet.com, okay, and look for the Learn tab or right here, you can get our free C++ HFT ebook on infrastructure and most of the firms, or you can just go into the Learn tab here. Same thing, don't release your info, blah, blah, blah. And that's pretty well it. Thanks for watching. Have a good day.